The S&P and Nasdaq both closing at records again. The S&P above 6,300, while the Nasdaq briefly topped 21,000 during the session. Our next guest believes a rally can keep going. Megan Horneman joins us now. She's the CIO at Verdence Capital Advisors. Megan, great to have you with us.
Thanks. How are you?
You know, it's funny because when I read the notes, it sounded like you were maybe concerned about the tariff deadline, which you don't think will be extended. So what happens with the markets there? We're still on track to go even higher?
Yeah, I think, again, longer term, still optimistic. Think that we're, not in a bear market here. We think this bull market could continue. But there's a lot of volatility, and what we're concerned about, complacency entering the market, especially ahead of these August 1st deadlines.
So what are you doing? Because we have volatility very low. We have markets high, and you suspect that markets are in for trouble. So how are you sort of preparing for that patch of roughness?
Yeah. So first of all, make sure that where you're positioned is where you want to be for the longer period of time. So rebalancing may be necessary, especially after you look at such a rapid increase that we've seen since Liberation Day. So make sure that you're allocated appropriately. Look at some of the areas that are not pricing in perfection. So I think that, there's a lot of talk on this call about technology. I think technology growth, some of these sectors are pricing in perfection. They're not considering the risks that are out there. When you look at multiple high, you look at some of the, whether it's technicals, looking at overbought conditions. These are things that we think might upset the rally that we're seeing here. But we still would view any pullback in the market as a potential buying opportunity because, again, long-term we're positive. But in the near term, be very careful. This market is pricing in the perfect situation from a tariff perspective as well as the Federal Reserve perspective.
Megan, when you look at diversifying away from the U.S., there's only been a handful of times where international has outperformed the U.S. for extended periods of time. Do you think this is one of those times right now?
I think there's room for catch-up. I mean, it's been a very long time that the U.S. has just been completely outperforming the rest of the world. I think there is room for catch-up. So if you don't have international stocks in your portfolio, I think it's always a good time to have that diversification add in. I'd warn that right now they're expensive from a valuation perspective, cheap compared to the U.S. However, the U.S., as I mentioned, especially in that large cap growth area, is expensive in our opinion. But I do think there is room for the longer period of time that there can be some catch-up. They've been underloved for way too long, and I think you're seeing some of that rotation just begin. I think that can continue.
Megan, the Fed risk that you speak of, is that Jerome Powell getting blown out, or is that the Fed not cutting rates in the way the market's anticipating?
Not cutting rates. We originally, coming into this year, thought, the second half of the year would be when they would start cutting interest rates. We said September. That was pretty much our case. But now I think there's less than a 50% chance that they can cut in September. Let's keep in mind inflation is stuck. I know that everyone talks about how good inflation is going. Yeah, of course, it's gotten much better, but it's stuck here and actually not necessarily moving in the right direction. And the Fed's just not going to have enough information by the September meeting. Even if we go in and put all the tariffs back in place on August 1st, that's not going to really show into inflation until whether it's October, November, maybe even December. So what's the rush for the Fed? They have the flexibility. The economy's not completely tanking. The labor market's okay, not great, but it's not tanking either. What is the rush? Because the White House wants lower interest rates. Every president wants lower interest rates. So we think they have the flexibility to just remain on hold, see what happens.
Megan, in terms of the market, though, as a monolith, and you've talked about the risks, and we've had a conversation about the world out there. Today was a really important day, not just because the S&P went above 6,300, but the NASDAQ 100 on a relative high, has made a fresh relative high to the S&P for the first time since last July 10th. I think this is a very big deal for the direction of the market, not necessarily because individual companies underneath it are the ones we're going to make a call on today, but because the market itself, at this point, with, I think, a lot of institutional investment not fully invested, is now making a new relative high, at least the growthiest part of the market. What do you think about that?
I'd be careful of the growthiest part of the market right now. Long term, yeah, of course, technology is going to benefit from the AI evolution that we're seeing here. But in the near term, are the valuations fully reflecting that, the upside? I think they are at this time. I think there still is room for a valuation correction. I think that, as we mentioned, that some of these growthy areas with the high PEs are just pricing in way too much expectation for Fed rate cuts. Once we see that might be priced off the table, coinciding with the fact that we're not quite sure what's going to happen with the tariff perspective, I think you can see a bit of a valuation correction. And you mentioned that you're seeing institutional buyers, everybody jumping on this bandwagon. Is that a momentum trade as well? And we've seen what happens with momentum trades.